Homeowners insurance in its current form is only about half a century old. That is, prior to the 1950s, 1960s, there was no such thing as comprehensive homeowners insurance. You had fire insurance. You had liability insurance. You may have other sorts of things. And at some point, the insurers decided, okay, it makes more sense to bundle in the current language all of the elements of homeowners coverage together. So homeowners insurance 1.0, fire insurance. Homeowners insurance 2.0, what we know now, a policy which covers lots of things, including both property damage and liability coverage. What's homeowners insurance 3.0 going to look like? Nobody knows, right? Because we're talking about the next, say 20 years, to pick a number. We have seen a number of proposals, and as in California, Florida, Louisiana, an increasing number of places, insurance becomes either less available or less affordable or both, with the result that you expand the residual markets or people go uninsured or I don't know what. I don't think we're going to see tweaks to the current model. I think we're going to see fundamental changes because the risk landscape is just changing too much. What might those look like? Well, nobody knows, but there are efforts going on that suggest some possible solutions, and we'll have time to talk about this at the end. I'm sort of interested in this. One of the ones that's the range of things that are most likely is because a lot of the economic problems with our current insurance system arise out of natural disasters. Suppose we change the way we think about cat insurance. So we have NFIP, which, as you know, keeps changing due to the political winds. We have the California Earthquake Authority. We have windstorm coverage in some states. We have a variety of things, all of which are highly problematic. Well, suppose we think about ways to put all of those together. That is, I live not that far from the Jersey Shore. I'm really not at risk of earthquake. I'm at risk of hurricane a little bit. Suppose we consider both of those losses as quite similar and create essentially a national risk pool. Because most people across the country are subject to some kind of catastrophic risk. And we could do this in a number of ways. We could make proposals out there, make the federal government the insurer of last resort, basically, or the guarantor, which is functionally the same thing. Create a policy that would cover all of these risks. Do other things like that. Interesting suggestion, several dimensions to the problem. One is the economic problem, right? How do you figure out what everybody should pay? Two, of course, is the political problem, because nobody wants to pay more than they have to. And if you represent Nebraska in the Senate, your interests are different than people who represent New Jersey. Three is really a fundamental question, which is, what do we owe each other? Do we think of insurance as a private, financial, actuarial transaction where everybody simply bears their own risk? Or do we think about the insurance system as part of our collective responsibility to each other? We know in other areas we feel collective responsibility, right? Social Security, Medicare, Affordable Care Act, a whole bunch of other things, highway construction, where it's not the case that users pay the cost related to their benefit. Should we do something like that, at least with cat insurance, if not otherwise? So that's one possibility, one thing that might happen. Second possibility is, let's go back to a different version of homeowners insurance 1.0. Let's disaggregate some of the benefits and losses. For example, if you think that the primary function of homeowners insurance is to protect against large financial losses, let's create a policy that makes sure everybody is protected against those, which would necessarily include taking out some elements of the current policies. And you could do this at a big level or a small level. For example, most people buy deductibles which are too low. $500 deductible, $1,000 deductible makes no sense because nobody in their right mind would file a claim for $1,100. Suppose you had quite a substantial deductible, and that's the core of the homeowner's policy. And then what would the insurance companies do? They would create a market for a second policy, which would be more like a home warranty. It would have limitations, it would have exclusions, but something to take care of the small losses. And maybe that's a different formulation. Third possibility that I've been playing with, haven't quite figured this out yet, of course. So, you know, Berkshire Hathaway now has a business owner's policy called 3, which is called 3 because it's 3 pages long. You ever seen an insurance policy that's 3 pages long? You should go look at it. It's very interesting. And of course, you know, the critics are all up in arms because it's not quite as comprehensive as typical business owner policy or business interruption plus property damage plus whatever. On the other hand, it's pretty good, it's reasonably priced, and if people want to read it, they can pretty much understand it. 3's taken. So I've been sort of thinking, okay, is there a 4? Could you do a homeowner's insurance policy that would be 4 pages long, which would necessarily incorporate some of the other concepts, narrowing risks and so forth, but would give people the basics of what they need? So in those and other ways, we're going to see a different kind of homeowner's insurance in the not too distant future. What do we do in the meantime? Well, one thing we could do is we can mandate coverage, which in a sense is not just going forward, it's going backwards. The 1947 New York Standard Fire Insurance Policy, which, by the way, still provides a baseline of coverage in a large number of states, the 165 lines. Legislature adopts an insurance policy, it's in the statute, and says if you provide fire insurance, you must provide at least coverage this good. You can provide more, and of course everybody does. And interestingly, there's a number of, there's pieces of litigation here and there which have the effect of saying, you know, current policies do not conform to the standard fire policy, and therefore the insurer is not providing the statutorily required insurance, which means they have to provide policy that provide coverage that the policy doesn't now say they have to. Particularly if you go to the Merlin Law blog, Ed Eshu, one of the Merlin lawyers, has done a lot of writing and litigation about this. Okay, and we see through the efforts of United Policyholders, through the efforts of many of the people in this room, state by state, lots of other coverage mandates tend to be in response to particular political issues, but we could think about that more broadly. I have a colleague who's suggesting we want to open up the market, of course. People can buy all kinds of insurance, but what we ought to do is update the standard fire insurance policy and say you must provide at least ISO HO3 coverage. Or the ISO HO3 is the default and you have to require specific consent to vary its terms, or something like that. So that's another possible solution as going forward. All of these involve a degree of market regulation. And as we know, in every state, the insurance market is regulated by, in Massachusetts, the Division of Insurance, Division of Banking and Insurance, Financial Services, take your pick. This is a regulator sitting at their desk tomorrow morning. There are better regulators, there are worse regulators. There are regulators who are more consumer friendly and less so, and it changes over time. Some appointed, some elected, some chosen, who knows how. And we should continue to press them. But regulators have what I think of as 2 problems. One is, like this person, they're overwhelmed. Most of the state insurance departments I have looked at are inadequately funded and staffed to do what they should be doing. They're looking at policy forms, they're approving rates, they're doing a bunch of other stuff. Very often, particularly because they're funded by insurance companies, they just are not quite up to the task, particularly with respect to market regulation. So last time I looked, there are a number of states which report the staff members in charge of consumer complaints will have a caseload of 400 to 600 at any one time, which is just unmanageable. So regulators are overburdened. The other problem with regulators, there's a theory of capture, that regulated industries come to capture their regulators over time. Well-developed research on that, which I think in many respects is true, but I think a more charitable version of that going on is, who do regulators talk to? Well, the insurance industry has lobbyists and representatives of the companies and other people in the regulator's office all day, every day, because it's their job and they care. And you talk to somebody all day, every day, they give you more information, you begin to see their perspective. Consumer regulators, some of whom are in here, they're not in Boston or Trenton or Sacramento all day, every day, because underfunded. And that sort of, I think, channels regulation in particular ways as well. So we could do market regulation, and one thing you should watch for, insurance law, so we have an insurance law center at Rutgers Law School, which we'd like to describe as one of the leading academic insurance law centers in the United States, because there's only two, us and the University of Connecticut. But in any event, in this early spring, we're going to come out with a rating of state regulation. How effectively does each state, rank them on a 5-star system, protect consumers? Because we know they do lots of things really well. They do financial regulation really well. They all do. Protecting consumers, not so much. And we have, metrics and categories and so forth. So watch for that about regulation. Civil litigation is an important means of market regulation that people often don't think about, right? So the cases you work on, many of which end up in litigation, have the effect of regulating the market and filling protection gaps. Why? Because the court will interpret policy language in a way that forces insurers to pay claims they might not have otherwise, because it sets standards for claims practices to which insurers have to adhere. In all but a handful of states, the standards aren't good enough, but still, it's something, and so forth. And therefore, civil litigation, particularly bad faith litigation, plays an important role. And one of the things that a number of people here and elsewhere have been lobbying for is strengthening the regulation available to consumers. Because if you assume that regulators are too busy and not particularly oriented to protect consumers, what's another way to do it? Well, you give the consumers and their lawyers the ability and the incentive to do that. In many cases, so because of where I work and what I do, I'm sure like you, I get calls, I get emails from somebody who's had a house fire or something. And in many cases, I don't have anybody to send them to. I'll send them to a public adjuster. But if they've been badly treated, I don't have anybody, a lawyer to send them to. Because if you have a $50,000 loss, how much is it going to cost to litigate that? It's going to cost a fair amount of money, and many of the lawyers who could do it will say, I don't feel good about taking half of that recovery. I just don't want to do that kind of case. So attorney's fees and other sorts of things, but keep in mind civil litigation. Okay, so that's the regulators, that's the law. I'll come back to the regulators a little bit, but let's think about the market. And this is what I've been doing more recently.
First Party Claims Conference is intended to be a conference for all first-party claims professionals. So whether you're a public adjuster, an independent or company adjuster, whether you're a defense attorney or a plaintiff's attorney, whether you're an engineer and architect who solely gets your work from one side of the fence or the other, the intention of FBCC is to bring all those people together under one umbrella for education, for networking, and to find common solutions to the problems that we all face in the industry.
For me, it's a great educational experience, and I go, frankly, to learn a lot of technical aspects with respect to property insurance adjusting, and it's the reason why I think a lot of other people go too, and why it's worthwhile to do so.
Right, so the market, exchange goods and services, all the stuff you learned in economics and so forth. Are there ways to influence the market to reduce protection gaps and therefore better protect homeowners, insurance consumers? The problem is insurance consumers are not Mr. Spock. They're not knowledgeable and they're not rational. And that means all sorts of things. It means they're not rational because people often make bad decisions. You know the literature on behavioral economics, not all of which is as reliable as it's put out there, but still, people tend, for example, to insure against high probability, low value losses at the preference of low probability, high value losses. It's why they don't carry enough insurance, but they want a low deductible, or they want the $1,000 protection of their computer against a $500 computer, and other sorts of things. So people are not good at this. But more importantly, even if you are a pretty savvy consumer, it's awfully hard to be an insurance consumer. First of all, insurance is the only product I know of which you cannot know what you're buying before you buy it. I know no insurance company who will send a copy of the policy to somebody shopping for insurance. Last time I changed carriers, I had a conversation with the representative, and I said, will you send me a copy? And they said no. And I said, why? And the person said, well, we just don't, right? They knew there was no good reason. But since you're obviously a savvy person, we use the HO5 policy, so just go look at that. Okay, most people would know what that was. So you can't get a copy of the policy. If you could get a copy of the policy, that's not enough. Why? Because you can't understand it. In many jurisdictions, required to be written in plain language and legible and 12-point type. Doesn't matter. There's terms in there that the average person would not understand. And more important, I think, they don't have the knowledge that you do. That is, even if you can read and understand the policy, you can't visualize the situations in which you're going to have a loss and a dispute with the insurance company may arise, right? Let's say, oh, okay, I'm covered for plumbing leaks. They may not think of the fact that, gee, there could be a hidden leak. Or, take your pick of the issues you deal with all the time. So so I must say, this is not a be-all and end-all. I'm aware of that. I'm generally not a disclosure guy, but I'm sort of stuck there because I don't know where else to go. How do we make it easier for people who are not Mr. Spock? Well, the states do some of this. This is from the Texas Office of Public Insurance Counsel. So there are 6 states in the union, 6, that publish online the policies in force in that state. 3 of them publish all the policies, 3 of them publish the top 10 insurers by premiums or something like that. Not bad. Couple of those states, Texas and California in particular, then break it down and say, okay, so what do you want to know about the policy? Well, type of coverage. Oh, water damage. What are you covered for? So you can pull down, gee, I'm comparing Allstate to State Farm. What's the difference in water coverage? That's good. It's not good enough. That's pretty good. The other thing they talk about is the quality of the company. What does quality mean when we're talking about insurance companies? It means 2 things. One, it means financial stability. They'll be there to pay the claim. I said before, I don't worry about that because it's the one thing regulators do really well. So in 2022, 8 property casualty insurers in the United States became insolvent. 5 of them were in Florida, sorry, Nancy, right? But with its unusual situation. And of course, in most of those cases, there are guarantee funds backing them up. So, I wouldn't tell anybody to look up the AM Best rating, even if they could understand it, because the company's going to be there to pay the claim. The other thing is they're going to be there to pay the claim. How likely are they to pay the claim? And, okay, so one thing we could look at is consumer complaint ratios. In practically every state, you can complain to the insurance department, and they'll, in some cases, really do a good job, in some cases not so good a job. It's a highly complex system. The information is not that good, but it's something. So here we can look at the Allstate, different versions of the Allstate company in Texas. How do they do relative to the average company? Oh, they get 3 times more complaints. That's something. And we'll talk more about claims quality. But this is what the states do to try to provide information. And then, of course, there are the commercial efforts. The people, particularly on the web, not just the agents down the block from your house, who are trying to sell you something. Insure.com, Value Penguin, US News, take your pick. I just picked NerdWallet just because I don't like them. Best home insurance in New Jersey for 2023, and they give you a list of a number of companies. Oh, let's look at State Farm, which gets 5 out of 5 stars because it includes more generous dwelling coverage in standard pricing than many others do. No, simply false, right? They just make this stuff up. And yeah, they have the little statement there. Oh, this is completely independent advice. Yeah, this is completely independent advice. And that's why if you click through, they get a piece of the action. Worse than worthless. So we don't do that. So our insurance law center, the Center for Risk and Responsibility, this is what my law school building looks like at night. A lot of you are construction people. This piece of colored glass, which is illuminated, was designed by a New Jersey artist, of course, fabricated by some firm in Germany, because they're the only people in the world who could do this. And they came in and installed it. And boy, are these people good, right? You're putting glass on a curtain wall, and it just looks beautiful, and we hope it's safe. Okay, back to consumers who are not Spock. What are we going to do? Well, they can't get the policy. They couldn't understand the policy, and they wouldn't know it applied to anyway. Is there a way to provide them a summary of what they ought to be thinking about? Oh, there is. For example, one of the innovations of the Affordable Care Act was the summary of benefits and coverages. If you go to healthcare.gov and you are shopping for a policy, the health insurers must provide information with standard questions and standard answers. They have to pick from a list of answers. And if for some reason they have a slightly different answer, they have to have their language approved. And things like, oh, what's the overall deductible? And it'll tell you. Are there services covered before you meet your deductible? And so forth. Oh, okay, so that's good. I can compare. And even better, we can't really do this with homeowners insurance quite the same way, but close. Peg is having a baby. Okay, so if you're concerned about obstetrical costs under this policy, if you buy this coverage, here's likely what your benefits are going to be, here's what it's going to cost you. And if Joe has type 2 diabetes, and there are a bunch of examples like this. Again, not everybody's going to go through this, not everybody's going to understand it, but boy, does it clearly communicate a lot of the really important things. So we ought to do that too. The first problem is, you read lots of insurance policies, traditionally, they're organized abysmally. I know you spend time probably trying to explain what particular provisions mean to consumers. Try sometime to explain the structure of an insurance policy to a consumer, because it makes no sense, right? It's simply a product of history. So what we did was we said, okay, so first thing we have to do is we have to reorganize the policy. And then we have to prioritize the terms. We reorganized it and said, look, if you were trying to explain to somebody what their homeowner's insurance covers, the first thing you do is you separate property insurance from liability insurance. And then property insurance, which is the big bang for the buck, what things does it cover? What risks does it cover? And how much is it going to pay if you have a loss for one of those things within that risk? And then there's a few odds and ends that we think are particularly relevant. reorganize the policy in a way which would be accessible to consumers, and we have developed a template which mimics the Affordable Care Act Summary Benefits and Coverage. This is sort of the introductory thing. Tells you what you're going to get, highlighted terms with definitions, and like theirs, what structures does it cover? Oh, it covers the dwelling and other structures, hyperlinked definitions of those, and so on. Gives you things to look at as well. Oh, if you have a particular situation, be careful of this. And do this for every policy, all of a sudden you're giving consumers somewhat accessible information. And just like PEG is having a baby, give them more detail. Oh, water losses? Here's the differences among policies with respect to water losses. That is, here's what this policy covers, and here's what a lot of other policies covers. This is all on our website. I'll give you the link to it. You don't have to, look at it now. And let's run some numbers. Oh, okay. What's the difference between replacement cost and actual value, actual cash value? Well, there's a definition, but let's look at money, right? Let me read. Some of you are peering. Let me read from you. Kitchen fire requires replacement of the cabinets and countertops. Total cost is $15,000. Replacement cost pays $15,000. Actual cash value pays the depreciated cost, $7,500. Fire requires rebuilding substantially all of the house. Cost is $200,000. Policy limits are $150,000. And then it goes on to explain the difference between replacement cost, extended replacement cost, guaranteed replacement cost. Okay, I can visualize that. Now, what I say, which is not entirely true, is, and therefore you can make an educated choice. You can only make a half-educated choice, because like we said, not Spock, but still, give consumers key information, not with respect to every term of the policy, but what's most important in a way that if they choose to, they could probably understand it. Okay, so that's coverage. Now let's go back to quality of claims. The first one, the coverage summary, this one, I avoid grandiosity. I don't know if it has any chance of being adopted by any regulator anywhere, but it doesn't seem to me there's any good argument against it. Doesn't mean it's going to be adopted, but there's no good argument against it. This one, I predict, will never be adopted by any state anywhere, but I think it's important to raise the issue to sensitize them to the problem. So financial stability and how good are they at paying claims? Right now, if you want to know that, you can talk to somebody in this room. We could play this game, right? Who are the best at paying claims? Who are the worst? And we'd probably coalesce. Most people can't do that, because they don't have access to this degree of expertise. There are two reliable places you can go. One is Consumer Reports, the other is J.D. Power, because their surveys are accurate, valid, reliable, sufficiently large to count. So that's pretty good. But I'm a data guy, so I'd like data. It turns out there is data. We've seen the complaint data. This is the California version with respect to, so State Farm has, I can't read it, but, relative to the average insurer, they're a little better, a little worse, whatever. Not good enough, because not enough people complain to the insurance department. Oh, and even if they do, there is this complicated analysis of a complaint which is accepted or confirmed or how it's decided. It's incomprehensible. There are claim statistics in, I think, last time I looked, 47 of the 50 states. The state insurance department collects on a form called the Market Conduct Annual Statement information on the claims practices of each insurer, which then the state takes it and reports it to NAIC, which aggregates it and reports it back in some fashion to the states and to the insurance companies. Like, how often are you sued by someone whose claim has been denied? What proportion of claims do you deny? How long does it take you to pay claims and so forth? I think that's great. I think we should have that kind of disclosure. Okay, so let's look at State Farm and let's compare them to all insurers of the state or the top 10 insurers or something, so I don't care. How frequently do you deny claims?
First-party claims conference is intended to be a conference for all first-party claims professionals. So whether you're a public adjuster, an independent or company adjuster, whether you're a defense attorney or a plaintiff's attorney, whether you're an engineer and architect who solely gets your work from one side of the fence or the other, the intention of FBCC is to bring all those people together under one umbrella for education, for networking, and to find common solutions to the problems that we all face in the industry.
For me, it's a great educational experience, and I go, frankly, to learn all the technical aspects with respect to property insurance adjusting, and it's the reason why I think a lot of other people go too, and why it's worthwhile to do so.
And if you're State Farm and Allstate, who are functionally quite similar, and one has a substantially higher denial rate, gee, I would ask why that is, and maybe I'd go to the other one. How frequently do you fail to pay within 60 days, 90 days, 180 days? Pick your number. They collect all this data. And so on. How frequently are you sued? How frequently do you lose those suits? One of the things that consumer information does is it makes better consumers. The other thing consumer information does is it improves market conduct. You can bet that if we publish these sorts of statistics, companies are going to have to start paying a little more attention to their claims practices, because otherwise they're going to lose business, because people are going to look at this and see that. So, that's sort of what we should do to measure quality. Okay, so that's what I would like regulators to do. But not surprisingly, regulators don't often listen to what I want them to do, but we keep trying. What do you do in the meantime? True story. 2 years ago, my dishwasher caught fire. No damage beyond the dishwasher itself, cut the power to it, but it was the fancy electronics, didn't make any sense to try to repair it. We go shopping for dishwashers. I don't know anything about dishwashers. What do? I do what the 6 million members of Consumer Reports, and probably lots of other people do. I went to Consumer Reports. And Consumer Reports says, okay, here's some large number of dishwashers, and we will tell you two things. One, we will describe the methodology, but you don't care about the methodology, really, true. And we'll give them a score on a scale of 100, and then group those, 81, 79, 78. And two, we will identify the things that are most important in buying a dishwasher, like how long does it take to run the cycle? How well does it dry the dishes? How noisy is it, and so forth? And we will rate them there. And you can buy whatever dishwasher you want, but now at least you can know, it's really important to me to have a quiet one because it's in the room next to where I watch TV. So I wanted one highly rated. That's Consumer Reports. So the logical thing to do is to say, yeah, let's do that for insurance companies too. So what we have done is we have done that for coverage, homeowners insurance policies. Okay, how do you rate them? Because they're not dishwashers. Well, the first thing we do is we reorganize the policy, as I said before. Second thing you do is, this is the site, RU Insure Score. My communications director said, you got to have a catchy name that can convert into a hashtag, RU Insure Score. How frequently does a loss occur? How large are the average losses, frequency and severity? How much do the terms vary among policies? For example, replacement costs for the dwelling is hugely important, but everybody pays replacement costs for the dwelling because somebody requires it of them and so forth. What kinds of coverage should policyholders reasonably expect? So we broke down the homeowners policies into 100+ elements. We looked at the available data from all of the sources, underwriting data, Insurance Information Institute, elsewhere. Yeah, what do the numbers tell us? And then we workshopped our proposal with a number of people in this room and other sorts of experts and said, okay, so we've identified factors. Now we can do what Consumer Reports does. Rate them on a scale of 100 and break down categories in 5 stars. Now, let's play a game. We don't have to do this out loud, but we'll do this as a thought experiment. The first hard part of this is getting copies of the policies, and for reasons you don't care about. We can only get policies which are pretty much the same from state to state for 11 of the 20 largest homeowners insurers in America. Okay, so it's a somewhat limited universe. And then we rated them. On the 100-point scale, think for a minute, top 2 and bottom 2. I'm sure if we were to do a survey, substantial agreement. Top 1, oh, let's do this out loud. Top 1, Chubb, of course. In part, and it's a little bit unfair, but we threw that in because they're so good, because they're in a different market than everybody else, right? High-value properties, okay. Bottom of the list? State Farm? What was it? Farmers? Here's the list. Chubb, 94. And then a big drop. These are only terms of coverage. This is not rating the company itself. This is only the basic policy which they sell from state to state. Number 2, Amica. Number 3, Travelers. Bottom, Allstate, AmFam, Farmers, State Farm a little bit better. Oh, remember NerdWallet? Much better coverage? No. And everybody in between. And a quick summary. If that's all you want to look at, cool. If you want to go deeper, and again, this is all the details on our website, here's, in a sense, why we rated them that way. Who's better on things the insurance covers, risks the insurance covers, what the insurance pays, and so forth. And on the website, there's a somewhat detailed account of the methodology. We don't tell you how we came up with the numbers, just like Consumer Reports and J.D. Power, but we tell you what we think is important, more important, less important, and so forth. And what I say to people, which is also not entirely true, I'm sort of prone to that, is, look, if you want to buy Allstate 73 rated because it's a little bit cheaper, go ahead, I don't care. I really do care. I want people to buy better coverage, but I understand that people are in economic situations where you may not be able to afford something near the top of the list, even for the others. At least what this does is it gives you questions to ask. Oh, wait a minute, I saw on RU Insure Score that you have a problem with what you pay, and that includes things like, whatever. Can you explain that to me? And they may decide, nah, it's not important to me. Okay. But now at least you have a way to do it. So what we would like to do in advance of regulation, what we have done, is intervene in the market. Now, the reason I say I'm recruiting you is you need to get the word out, on both the legislative regulatory proposals and on this. Tell people. And tell them to look at it. If they don't like it, that's fine. But at least, let's get the word out. We've been buying Google ads and a bunch of other things. No outside financing. The technology transfer at my people at my university wanted us to license this. If you're highly rated, you can use this. Won't do that. Completely independent of anything. But at least a possibility. And the detailed rankings. So the website, crr.rutgers.edu. Homeowners insurance projects, all there, and that's where we are. So we have a few minutes left, which is good, to which I would invite comments, questions. In back. The website, absolutely. And I have little handout cards if you'd like to take them and pass them out, even better. Amy.
So, when Lemonade first came out, they had this app about we're different because, kinder, gentler claim handling them. They kind of got shot down by regulators. You guys are just a plain vanilla policy. So my question to you is, are you seeing any genuine innovation in the market in terms of a carrier selling a simplified, more consumer-friendly product?
I'll take half of that. I am seeing more information, more innovation, selling a simplified, consumer-unfriendly product. That is, a lot of these insurtech companies are worse, not better, right? Both in terms of coverage and in terms of service. So Lemonade, which I particularly despise, World record for paying a claim. Somebody lost a coat which was worth $970, and their app paid it in 3 seconds. Well, I don't know why I put in a claim for a $970 coat, frankly. Maybe. But I don't care about that. I don't know how they adjust homeowners' damages, but I know they don't do it in 3 seconds. And as long as I'm on a pet peeve, give back 1% of their profits, which amounts to about the cost of half of a mocha latte for each of their policyholders. And they initially started pitching the behavioral economics of this, like you have to do a video where you say at the beginning, I'm going to tell the truth here. Because there were studies which said if you require that at the beginning rather than the end, people are more truthful. Great fact, those studies were fabricated. The data was made up. Right, so lemonade. Sorry.
No, totally fine. It was terrific. Great talk. Also share your deep hatred of lemonade. My question for you, earlier we had talked, there was some reference to telematics insurance, which we see in the auto industry. Telematics?
Yeah.
And I was curious if you had any thoughts on property.
So that's actually a different version of that, is a real innovation that I'm seeing from some of the traditional carriers, which is, you probably know this, okay, let's not just focus on the losses, let's focus on mitigation and resilience, right? Just like they're doing in flood. So my carrier will give me a discount if I install the Moan or one of the competitors' water meters that tells if I have a leak. So I haven't seen so much that they're monitoring usage as the auto insurers do with telematics, but they're taking advantage of the technology. You know, some of them have discounts on security systems and fire alarms and stuff, which is a good thing. And back. They sell this to the landlord?
Yeah, we're seeing it really big in Pacific Northwest.
Wow. So we have restricted ourselves to homeowners because of, I would love to see that, right. You know, you need to see the details, but there's an insurance law doctrine called illusory coverage, which says if they sell you a policy which doesn't fundamentally promise what you think you're buying, then the limitations in the policy are void and you have to cover it anyway. So the example is, I don't remember the name of the policy, but a contractor would buy the policy to cover damage to the building they're building or something like that. But there's an own work exclusion, that it doesn't cover your work. Wait a minute, that's exactly why you're buying the policy. I would be curious to know if they're selling a policy which fundamentally doesn't give.
I'll get your information.
Okay, cool.
The other thing is regional carriers. Have you gotten into rating regional carriers? We have a great regional carrier that I've never gotten a client from because they just take care of the client.
Yeah, so we decided to do the national, we started actually thinking of doing this state by state, which is a problem because we could practically only do that in the states which publish policies because the NAIC site for policies is terrible. And then we've said, you know, first of all, none of those states are New Jersey, which is sponsored by university, and the resources would be intense. We just couldn't do that. I think it's a great idea. We would be happy to partner with people to do that. And I will reaffirm your comment, which is when people ask me about some small regional carrier I've never heard of, I often say, I don't know them. But many of the small regional carriers are really good. Occasionally, I get invited to insurance industry events. I wish I could remember the name of the company. I was invited, I was talking to this guy who has a company in northern Minnesota. It says policies to farmers in Minnesota and North Dakota. And he said, I don't have to pay every claim, but I have to make sure my client is treated fairly. Because if they're not, they're going to go to the Grange, they're going to go to the Elks, they're going to go to church, and they're going to talk about it. I'm going to be out of business tomorrow. So we would love to have people who take our methodology and expand it, don't have those resources. It's 2:30. We should end our official session, but I'm hanging around if you have questions. So thank you for coming.